Craig is the CEO and president of the Arden Group. Craig and I have been working together for about 30 years, just about 30 years. And the relationship with our firm and Craig's business have transformed quite a bit over those 30 years. And Craig's going to tell us a little bit today about how he started, how the Arden Group started, how it transformed into what it is today. And then he's going to spend even more time, we'll keep that part short, but he'll spend even more time telling us how he feels about real estate, the real estate industry, the real estate asset classes that are out there in today's environment, and where the opportunities are in the real estate space today. So I don't want to take any more time away from Craig. Craig is joining us. Craig, you're there. I think I see you. And I'd like to start with asking you to introduce yourself, the Arden Group, how you originally started the Arden Group, and what type of real estate you did, and how then you moved to what you do now in the fund platform stage that you're in.
Right. Thanks, George. And, thanks for having me. I'm a 33-year, almost 34-year client of the firm. And yes, I did start when I was 3. So it's been a good run. And thanks, Jill and Carrie, for doing this. I've been involved in a couple of these things, and it is a monumental effort to do. So as George, I'm in the quick background. I'm a lawyer by background, started Arden in '89 during the RTC crisis. Built up a really good operating platform. And we were essentially a transactional shop, the way I would define it, for about 24 years. And simply meaning we would find a deal, raise debt, raise equity, and hopefully execute and perform. The real estate capital side of the business started changing in 1990 with the advent of real estate funds. They really didn't exist before that. And they went from roughly 0 to about 1,800 globally today. There's always a little less, a little more in any one year. And they've really come to dominate the real estate business. And in certain areas, they completely dominate it. In fact, it's very difficult to compete. And for what we do for a living, which, George knows, I define what we do is buying institutional quality real estate. So, by that metric, it's sort of bigger, better assets and bigger, better markets in non-institutional circumstances. So our seller has a stress point. We'll talk more about that later. But that stress point causes them to focus on the surety of close as opposed to price. And surety of close in our simple language means you have discretionary funds. You don't have to go out and raise money to close. So out of necessity to stay competitive, and we're a pretty competitive group of folks, we converted to a fund platform in 2012. We only operate out of funds now. We have equity funds and debt funds, and George was there, and everybody at CLA, for that matter, was part of that transition. And it's been an extraordinary transition for Arden, and it's a place that we'll keep going. We won't look back. And I think it's definitely allowed us to become an even more competitive firm.
Thank you, Craig. So tell us a little bit about what the philosophies that contrast for us, the philosophies that perhaps you followed in the past versus what you follow today in what you do in investing in real estate.
Yeah, there are some consistencies. I would say the two primary that I can think of would be when we got into business, we were going to be a trader. I came out of this as a lawyer through the RTC crisis, and I actually, as an attorney, represent some very large real estate families in Philadelphia. And what seemed like on a Friday, they were the wealthiest people in the city. On a Monday, they were broke. And it was extraordinary to watch. And that idea of hanging on to real estate forever just because it's what we do didn't make sense to me anymore. So we decided right out of the gate we were going to be a trader. If we could buy a piece of real estate low, fix it and sell it high and make money, we were going to take the money off the table. Secondly, whoever came up with this location was very smart, and they're very right. So we were going to be a location-oriented buyer. Now, that has changed fairly dramatically because we learned by making good decisions and some not so good ones what that really does mean. And we've really honed in on that. So those are consistencies to what we did. But as you know, in the early days, we sort of took real estate as it came at us. It could have been any asset class. It could have been development deals. It could have been buying, fixing, selling. And we did a lot of it over the years. And we just learned what we're really good at, and we're very risk adverse. And so on a risk adjusted basis, we really honed in on a strategy that we thought gave us the lowest risk and the highest return in the time frame we were looking for, which is really what we do today. So today we are a simple buy it, fix it, sell it. Our average hold is about 3.9 years, call it 4 years. Everything we buy has got in place cash flow. Cash flow we're trying to grow throughout the holding period. And we're typically adding value to every asset. That's operationally and physically. And the physical is two things. It could be physical improvements you just need that you might not see, like putting a new roof on, fixing your HVAC, things like that. And then it's capital upgrades that actually do add value to the property that you might see. If it's an office building, it could be completely redoing your elevators, an elevator mod. It could be amenity floors, lobbies, putting in a Starbucks, restaurants, hotels, could be a brand change, upgrading rooms, corridors, bathrooms, things like that. And that allows you to charge more for that asset. So that's really what we do. It's not rocket science. It's funny. I like to say it's almost so simple that it's complicated because people can't believe it really is that simple. Now you have to have an operating background to execute, but again, we're not curing cancer. We're certainly not curing COVID-19. We're not building rocket ships. We're buying real estate in three primary asset classes today. Office buildings, what we call last mile industrial or logistics, and hotels. We're buying them from distressed sellers at a very low basis. We're fixing the problems they didn't or couldn't. We're getting it operating institutionally again, and we're selling it as fast as we can.
Thanks, Craig. So the world was humming along up until this past winter, and then of course you just mentioned COVID-19 hit, and everybody is living in this new environment. COVID-19 obviously has affected the entire world, has affected every business, every person, but certainly has affected the real estate space. And what I'd like you to do is I'd like you to tell us a little bit. You alluded to the fact that you're out there looking for opportunities, but tell us a little bit about what real estate assets right now, as we sit here, are in distress, and versus perhaps other classes, and why. What's going on?
I'll take a quick step back in terms of the world. Everything being great, it was, but we had been 10 years into an upcycle. And you know this because you were involved in our last equity fund. We had some concerns buying hotels. Hotels are like the canary in the coal mine. You really get to see what's happening daily and in the future, present time, because people are thinking about booking next year and the year after, and you're seeing it today. We were worried about the economy anyway. At some point, it had to flatten out and probably be a mild recession. So we sort of built the latest equity fund for that. We just, I think, got lucky. We stopped buying hotels, primarily started selling a lot of hotels. And then we started buying even better assets, more well leased with more in place cash flow, figuring yield would be a great thing to have in a recession. Obviously, we never predicted this, but I think we got a bit lucky and we were sort of structured for it. The simple answer is I can only speak to the asset classes we invest in, which are office, industrial, and hotel. And let's deal with them individually. Everything's been impacted by COVID-19. Even so, certain assets that we have are actually performing as good or better today. They're still impacted, and I'll just go through each one and tell you why. So office buildings. Our office buildings that we own, we started moving up the food chain. So we were buying the sort of AAA to trophy. Our collections as of last week are 99%. I just talked to Silverstein, our partners, this morning. Their office collections are roughly 96, 97% across a 20-something million square foot portfolio, high quality office. So that would lead you to believe there's been no material impact on office collections and therefore office profitability today. And I think that's true. And the question is, what will happen with it in the future? And I know you want to talk about that a bit later, and we'll get into that. So office collections are good. Industrial collections are very similar, but we have 4 million square feet, 650 tenants. Our collections are about 95 to 97% as of last week. So basically no impact at all. Industrial is the big winner. coming out of this, and we'll talk about that later. There's almost no negative impact of the pandemic. And in fact, if you had to check off 10 boxes, all boxes check off as a positive for industrial, and we'll talk about that. And then hotels, that's the obvious, right? In our world, we don't do retail. So hotels have been devastated across the board globally. And we'll talk about that more a little later, I'm sure. But generally speaking, to put it in perspective, September 11th was the worst event the U.S. had seen, forgetting all the humanity issues, but I'm talking about in the hotel business, that we'd ever seen. It was a dramatic drop and very quick, and it recovered fairly quickly. The global financial crisis made 9/11 look like a mild recession when you chart it out and look at it. So that was devastating, scared the hell out of people. If you combine 9/11 and the global financial crisis, the COVID-19 pandemic, you can't even underwrite it and see it. It is such a blip on the screen. When you chart it out, the drop in hospitality, occupancy rate, RevPAR, and value has been like nothing we've ever seen since they've been recording data in the hospitality business. It blows the Great Depression away. They're not even in the same category. So we've never come across this before. And then the key there is, if you own it, and we'll talk about what you own, because there's assets you probably want to own and should have never bought, but it's which markets will recover, right? And how quickly, and then how you budget that out. Because in the world of buying real estate today, you have to underwrite things you never had to underwrite before. Office and industrial, they're still the same cash flow, but values are down for one reason only. We're a leveraged business, right? Real estate generates leverage. REITs are 50%. Funds like us are 65%. And entrepreneurial buyers will borrow whatever they can. So they could go to 80 or 90 because they like the leverage. But we're a leveraged business compared to a lot of other industries. And the problem is there's so much uncertainty in the world today. Lenders have pulled back very quickly. And the lenders that are tiptoeing back into office, industrial, and some of these more stable asset classes, because of the perceived risk, what have they done? The cash flow is the same at the asset, but they've widened their spreads. So where we could have borrowed on office or industrial 6 months ago, 9 months ago, at maybe LIBOR plus 250 to 350, maybe somewhere in that world, depending on the asset. Today, it's LIBOR plus 450 to 700 for the same cash flow and the same asset. And because of the increased spread and debt service, it has pushed values down for the time being. Those will come back and come back quickly when the credit markets open up. And hotels are a completely different animal. It's nearly impossible to get debt on hotels today. And if you can, you're going to be, lucky to borrow 30 to 40% of the new purchase price, which is a, big discount to the old purchase price, where you used to be able to borrow 75 or 80. Now it's 30, 40 of a lower price, and the spreads are probably L plus 7 to 800 right now. So very low leverage, very expensive debt, if you can even get your hands on it. So when you remove leverage, it has a dramatic negative impact on asset values. But office and industrial will recover much quicker, and values will eventually get back to where they were, and I think get more valuable. And hotels are going to be a slog. And then you have to break hotels up between limited and select service, full service, and group hotels, and they're all probably going to have a different recovery time.
Yeah, I was reading an article in the Journal. It was either yesterday or today, and that the Hospitality Association, they sort of came out and there was some heads of hospitality, and they said that certainly if you see a vaccine or some kind of treatment for COVID, that the leisure part of the business would probably return very, very quickly. However, they're saying that might and probably won't be the case for the business travel part of the business. Do you agree with that? This is so different than anything that's ever happened in the past. All of us are making it up on the fly. I'm lucky enough to be in a couple small groups, but with people that dominate the hotel business. One group's called the Round Table. There's 75 people in the group. There's probably 75,000 that would like to get into it. And they represent every major private equity fund, and usually the principals, every major lender, and every major brand around the globe.
and you sign an NDA and you get in a room and talk about it. So it's real insight into what's happening. And the general consensus, and this changes a little bit, but there's been some level of consistency to the thought process. The hotels that will recover the quickest will be limited and select service, right? And that's a 1 to 2 year recovery, 2.5 years. It always varies by hotel and market and location. You know, I'm generalizing, which is a very dangerous thing to do. Full service hotels that would have some level of meeting space and restaurants, 2 to 3.5 years or so. And then what we call big box hotels, those would be hotels that have 25% or more group dependency in convention centers, 3 to 5 years. Just obviously people book out a year or two in advance and everybody's canceled. So nobody's even thinking about booking yet. So if they book next year, they're booking for 2022 and so on. That's the general consensus. And then how they fill up is right. I mean, the leisure market's obvious. The minute you open anything up, those hotels are packed. People want to get out of their house. We're communal creatures. That's who we are. We're never going to change. It's been happening for 25,000 years and it's not going to change. Business, one of the things we're talking about is talking to people like you. You know, how many employees does CLA have? I don't know, probably 7,000 or so, I'm guessing.
Yep.
It's firms like you who travel all of the time. And we're actually reaching out. And I've talked to Tony about this new. What are you guys going to do next year? What are you thinking about? I can clearly see business travel being certainly way down this year and next year being way down from historical norms, probably because, one, profitability isn't there, right? And then two, there's an uneasiness to travel. And you've had remote working like we're doing today. Normally, we'd be probably in a conference room somewhere, and there's a comfort level that this really can be pulled off. It does not replace being in person, and it never will. But there's a place for it. So when you add all that up, yeah, business travel will take a little bit to come back, and then conventions will take a little longer to come back, big groups. But eventually, you know, I believe there will be a full recovery in all of these sectors. And then you can dig in more in the hotel business, what that even means. The interesting thing in hotels, unlike office buildings and industrial, which are pretty simplistic animals, rents, few dollars in expenses. There's not a lot of moving parts. Hotels are an operating business. And what's happened in every crisis, and this one is even getting more dramatic, we're finding ways to get to profitability and a lot less revenue. And that's happening again as we speak. So I think from a pure gross revenue, and we call it RevPAR, revenue per available room, so that's a combination of occupancy and rate combined, that'll take a little longer to recover. And if we just pick a time for no other reason than to talk about it, if we think that's 4 years to recover, you actually may get to the same hotel EBITDA or NOI a year earlier and maybe faster, because we've been able to improve operations in a way through technology and protocols and other things. And this is even with new cleaning protocols. The consensus is we're going to hit profitability well before we hit the same peak gross revenue that we hit in 19.
Very interesting. What percentage of hotels do you think may never reopen, Craig? I mean, or do you think that they all, like, what do you think about that?
Yeah, it's a growing number. It's something nobody focused on in the beginning because no one knew how long this would last, but we're seeing it, you know, in New York City. There isn't a week or two that goes by that you don't see another big hotel that closed forever. These tend to be hotels that were a bit older, that were in need of renovation anyway. And then going into this, they've realized they have lost so much money that, unlike other businesses, is unrecoverable. You know, the money that we're putting into a hotel today to cover operating costs, whatever it may be, debt service, because you don't have the revenue, that's unrecoverable. It's basis creep. It just adds to your cost of the hotel. And a lot of people just realize this is going to take longer to get out of. They're not going to be able to get their hands on the capital to renovate, and they're giving up and closing the doors. So I've heard numbers, if you went back 2 months ago, it was 10%. There were numbers as recently as this week that are 20% of all hotels may close forever. And that is staggering. So what does it mean? If you're one of those, watch out. But some people are converting uses, right? You're seeing a lot of student housing and multifamily and senior housing and some other things. So some will get reused outside hospitality. But if you're on the other side, if you happen to have a really good hotel that is renovated, because people want to know that, and I think most importantly too, be with a powerful brand, then you don't have, not only do you not have the new supply that was coming like a tidal wave, but you're actually taking existing inventory and removing it. So you're going to be significantly more competitive in the future than you are today. And I think you'll see that happening in the hotel business. And the last thing I'll say, which is part of that round group, it's interesting. It used to be that boutique hotels were cool. Airbnb was exploding. Because of COVID-19, there's a sense of, is my room clean? And who cleaned it? And even so they say it, do I trust them? And you know, these big brands are all about trust. And I think on a go-forward basis, that sort of independent boutique hotel operator you never heard of, the Airbnbs, are going to face a lot of headwinds, because you've got to convince us, the traveling, whether they do it or not. I believe if I go to a Ritz-Carlton or Four Seasons, my room is spotless, Marriott on down. Those brands I trust, even if it isn't, I'm telling you, I believe it. And I think they will get more focused and better. Tell me I can stay in some one-off beautiful hotel. I don't know the operator, know anything about him, and I didn't do Airbnb, but I know a lot of people that do. Boy, you're going to think twice about staying in a hotel like that. So I think the brands, especially the bigger ones that have trust in the public, are going to be a pretty big beneficiary coming out of this.
Yeah, I've heard some things about it. Maybe Airbnb doesn't make it. So I've heard some thoughts like that. So in this environment, then, the Arden Group is getting ready to launch a distressed hospitality fund. Can you tell us what kind of that looks like, and tell us a little bit about the strategy and what the term, like how far down the road do you feel that an investment in something like that could come back and give appropriate returns?
Yeah, so because you're involved in all of them, we do diversified funds throughout 3 asset classes, and we like that. We think there's sort of risk mitigation and diversity, but we've never come into a buying opportunity like this before in a single asset class, and it's across the board. If it has the word hospitality related to it, it's in trouble. Period, end of story, global statement, and I'm 99.99% accurate in that statement. It's so great, but you have to have a certain risk tolerance to go into it. And you certainly better have understanding in the hotel business, right? It's a real operating business. It's not like the other asset classes. So for us, rather than take some equity out of our current fund that we have, which has plenty of dry powder, probably $350 million of dry powder plus co-investment capital, so easily a lot more than that. And rather than go all in on hotels because the opportunity exists, we didn't think it was the right strategy, nor was it appropriate, nor is it what we said when we launched that fund, as I mentioned earlier. It's a diversified fund with a lot of in-place cash flow, stability, those kinds of things. So we said, okay, what do we have? Maybe we let that fund go up to 25%. So that fund right now is about $850 million of acquired assets. 92% are trophy office and last mile industrial, 8% are hotel. I think it's appropriate for that fund to be 25% hospitality, but I don't think it should be more. So how do you play in the opportunity? The easiest way for us was to launch a separate distressed hospitality fund to be all things hospitality and really beef it up and bulk it up, not only with additional people we know in the industry that I've known for many years that have come on board to join us, but our board. We have a great board in our fund platform, but we created a separate hospitality board with world-class individuals like Mahmood Kimji at Highgate, one of the most prolific buyers, operators in the world. Marty Berger, CEO of Silverstein. Art Adler, who ran hotels for Jones Lang LaSalle globally for 15 years. Sujan Patel, who ran North Star and Colony North Star, and some others. So we've surrounded ourselves, Rick Kirkbright, right, he's the #1 hotel lawyer in the world. We've beefed up that group. And we're launching that fund shortly to take advantage of this extraordinary opportunity. So it's been a dramatic dip. In fact, if I had a chart, it would be great. You'd see it because you'd have September 11th, global financial crisis, if you can see, and then sort of this pandemic down here. But it's absolutely going to be a V-shaped recovery. There's no doubt about that. People are going to go, how do you know that? Well, because the drop was so far. The slightest tick up is V. There's no way around a V. The question is the V up like this? Does a V turn into a swoosh, or does it turn into a jagged swoosh? That's all about the vaccine. right? It's all about the vaccine. If you get a vaccine and you start pumping out hundreds of millions of vaccines and then billions, we're human beings. All you have to do is go back and look at the first time they opened restaurants and beaches, anywhere, across the board. Everybody went back. Life is normal. And I was at the Jersey Shore walking down the beach like 3 weeks ago, and we did it 2 days in a row, and I was curious to what I would see. Thousands of people on the beach, old people, middle-aged people, and really young people like me, and then kids. And I'm telling you, I saw 2 people with a mask. Not one elderly person had a mask, and there certainly was no social distancing that I could see. It was a guy in his mid-40s sound asleep on a chair, and it was a mom with her 2 kids. So that's the way people are, right? They're gonna come back that way. So I think you get a V-shaped curve, but I do think it's going to be staggering because we've had structural damage to the economy. That the virus is not going to impact after you have a vaccine. It's wiped out, and you'll know better than me. You guys, right, have this within CLA. How many tens of thousands, hundreds of thousands of small businesses are wiped out? They're not coming back. They're gone. And that is the structure. That's the backbone of the United States. And that's the problem. It's not the virus. The virus doesn't even impact that many people. When you get down to the real numbers, it's not as dramatic. You know, the news likes to make everything much worse than it really is. It's bad, by the way, but it's not like it says in the news. Having said that, you cure with a vaccine. You can't cure the structural issues. So I don't know, and you don't know, how many of these businesses will never come back. How long it will take to replace those restaurants, to replace those shops, which is a whole different discussion about retail and the dramatic change in retail, right? I mean, owning hotels is like, ugh, but they're coming back. Certain hotels, retail, and you tell me what it looks like in 2 or 3 years. So that's the issue we're all trying to project and figure out, and none of us really know. It's a guesstimate at best.
Sure. Okay, great. Thank you. I
didn't answer your question. Sorry about that.
Go ahead.
I think it's fairly quick. We're going to make investments in hotels like we always have. We're going to make investments in debt. I think you'll see the bulk of the transactions going forward will actually be loans, sold non-performing loans, because lenders are scared to death of hotels. It's the last thing they ever want to foreclose on, but they can't sit there forever. And this is for anybody looking in this industry. You're going to see a lot of lenders starting the foreclosure process and immediately putting their notes up for sale. So you see a tidal wave starting in the Q4. It's starting now, but it'll be Q4 right through all of next year and probably into 2022. And that'll be the biggest part. But there'll be entity level investments. You've already seen that. A friend of mine runs a $2 billion hotel fund, private REIT, Terry Watermark. They just brought investors in on an entity level basis. You're going to see a lot of that. And then you're going to see a lot of technology sort of affiliated with the hospitality business, the way it's changing. So this fund will be sort of all things hospitality. But I think outside of the entity level investments that will continue on potentially for a while, as a pure real estate play, I think we have 18 months to 36, probably 18 to 24 is a sweet spot for buying. And then it's executing coming out of this, and then it's selling those assets. That's probably the play.
Do you think it's like a 10-year window after the 18 to 24? No, not that long? Nothing's really ever been 10 years. Even the global financial crisis, as insane as it was, if you actually go back and look how fast we recovered as a country, generally 4 years, roughly? Maybe I'm off 6 months or a year, and then we were just riding up that way. This was a shock to the system. And then I think we come back like this. But what you'll have is you have hotels that are just gone, right? Just gone, never coming back. You'll have structural changes in boutique hotels, and the Airbnb that was worrying all of us in the hotel business is a worry. Now, what happens? Does that product go away? I don't think so, because so many people liked it. But it wouldn't surprise me if you see them get acquired by somebody that lays a brand on top of them that becomes a trustworthy brand that you can trust. There's absolutely a place for the, sort of home sharing business. It's not going away. I think it just looks a little different in the future in how they do it. So yeah, probably I think it's a 3-year buying window, a couple of years of executing and then selling after that. Got it. We're well into our 50-minute session here, Craig, about 30 minutes or so, and I want to move on to a couple of the asset classes that you and the Arden Group specialize in. But I also want to ask our CLA family members here. They certainly, if we can maybe fit in a couple of questions from them, that would be pretty neat. And if anybody has a question, they could start putting it in the audience chat. And we can perhaps handle those as they come along. Let's switch gears. You talked about office, and we'll save industrial for last. You talked about office, and you said that what you're seeing right now is, the lease collection rates are not really suffering that much. I guess I would say, well, I mean, if you have credit tenants and you're in long-term leases in these commercial leases, even if these companies don't have people that are going to the office, they're obviously making their rent payments, right? Because to them, it's sort of like a net zero right now because, it's not costing them anything more for people to be at home. But tell me what you think your future view of both urban and suburban office, perhaps, over let's say the next 5 to 10 years is, and what's your opinion about what companies are going to do? Are they going to shrink their footprints? Are they are they going to maintain the same amount of space? What do you think is going to happen there, and what's that going to do to lease rates as well?
Yeah. So, and by the way, for all of you, what George just was saying without saying, it's Craig, shut up. We're moving on. So George and I speak the same language. Anyway, on the office stuff, I'm a believer in urbanization. I do not think you're going to see people completely fleeing these major urban centers and going out to the suburbs. It's going to happen. I think maybe some of the millennials who are starting to have kids and things like that were thinking about it anyway, maybe it pushes them out sooner and some will go. But urban centers are urban centers for a reason. We've been going through an urbanization now for the last 15 years. It's projected to be a 50-year trend. Why? It's where you have what people want. You have arts, culture, restaurant, bars. People can get together, live together. The millennials love it. They love that kind of space. So I think there's an impact. But if you think New York City is going to drop and go away, some people do. I do not. It's been the financial hub of the U.S. and the world for a long time. I don't see that changing. So we are still a big believer in the highest quality urban markets. And we would absolutely invest in those markets today. I think they absolutely will recover. Again, I hate to put things by you, but once you get a vaccine and some other things in place, people forget. People have very short-term memories about that. And what does it mean for office? I think urban office will do fine if you're top of class. As an employer, if I want to prove to the employees that I care about them and I can afford it, I'm going to go to the best building. That's the newest building with the best technology, the best cleaning protocols, the best touchless systems where you can walk into the door, walk into an elevator and go to your floor without touching anything, the best safety, the best HVAC, air filtration systems, all of those things, and an office building that can afford to give me the money I need to improve my space. That tends to be, you need to be at the top of the food chain. So I think we are aspirational creatures anyway. I think this is going to accelerate that. If you can be in the best building, you're going to be. If you can't afford the trophy, you're going to go to the A. And if you can't afford the AAA, if you can't afford the AAA, you'll go to the A. I would be worried about owning sort of cruddy, crappy C and B and even A- buildings in urban centers, because people, to the extent they can afford to get out, are going to flee those buildings. They're going to go to better buildings because their employees are going to demand it. And especially millennials, they're a different breed, right? They'll just pick up and leave and go get another job if you treat them like that. So I think that's what you'll see. What was already happening, so there was like a 15-year trend where we were shrinking per square foot per employee, probably down to 130 or 40 feet. That a couple of years ago started changing. People were getting uncomfortable being jammed in. They were going back to, instead of hoteling, people were getting offices again. There was already a slight widening. And with this and the separation that people have, that's clearly happening. We see it already. Tenants calling in, I'll extend my lease, give me some money. So I think the safest way to bet, and I've talked to a lot of people, Silverstein, Brookfield, Boston Properties and others, the sense is, let's call it even. If you own the best quality buildings, which is where we want to be, You're going to have tenants who need more space because they have, oops, can you hear me?
Yeah, we can hear you.
Oh, I just lost the screen. I lost you. Oh, maybe Greg will help me. But
You're
anyway,
still on. Keep going.
yeah,
You're still on. Yeah.
Yeah. So what happened there, Greg? Oh, there you go. No. Anyway, what's going on there? Okay, there we go. Sorry about that.
Okay.
Anyway, so you're seeing a widening, and that's happening already. So arguably, if you have 20,000 feet and you're going to social distance and do what you're supposed to do, you may need to go to 30 or 40. But you've got remote working that's never been better. They tried it years ago, but with technology today, it really works. So let's just call that an offset. And that's kind of what we're already seeing now. We are seeing tenants who are saying, I may need more space, but I certainly need more money, and I'm willing to sign a longer term lease so you can pay more rent to get the tenant improvement capital today. So I think that's a safe investment, but you got to be the best of the best in the best locations in these dynamic urban markets, what we call momentum markets. Suburban, absolutely. You're going to see companies who are no longer going to have a single headquarters, no doubt. They're going to go to that hub and spoke where if you had 100,000 feet downtown somewhere, you may cut that back to 50 or 75 or the same 100, but you're going to move employees out to suburban offices. And I do think the suburbs will be a beneficiary of this, but it's the suburbs that are in close, right? That are where people want to live, work, play. No one wants to reverse commute from an urban center an hour and a half away to some cruddy suburban office building and come back. So I would bet on those suburban buildings that are relatively close to suburban hubs where we live, George. I would say Conshohocken, Radnor, right? I think they're going to do great. Even King of Prussia because of all the transportation systems. For those of you who don't live here, George knows what I mean. And these are really major suburban areas, but they're not that far from the urban center. And I think they will be a beneficiary coming out of this. And I think the best rents will go up. There's just going to be such demand for it. I think if you're not that high quality of a building, you're going to be in trouble. And every statistic I've seen is that office demand will get back to where it was in 24 months, and we'll start to see an uptick of rents again.
Nice
and
optimism.
Not, I certainly hope so.
Yes. We're going to move into some questions now and keep this going as we're getting down to the last 10 or so minutes or 12 minutes. One of the questions came in from someone, and it was actually on my list, but we'll go with our colleague's question. What are your thoughts about the role of opportunity zones in our economic recovery from COVID-19?
I think the COVID-19 affected it more from capital and opportunity than structural changes to OZ. And what I mean by that is, George, we have an OZ fund. When it first started, there was this sense of a tidal wave of equity coming in. So sponsors, the developer with the deal, felt the pendulum was on their side. And they could ask for any kind of return metrics they wanted. And there was so much money chasing their deal, they could get these extraordinary deals. And what really happened, because the legislation is complicated and it didn't get really finished in time, the amount of money coming into OZs was less than people thought, at least the pace. So the pendulum was slowly shifting back to the money. And with this, which has annihilated a lot of people's value, originally in the stock markets and then their ability to sell businesses, the amount of money flowing into OZs is at a trickle right now, although we still see it. I think it will come back and come back large, but it's going to be a delayed response. So what's happened is that pendulum has actually swung to the money. So today, the deal that you would have negotiated with a developer to either buy an asset right before it opened or to invest in their deal would have been highly beneficial to them. Today, it's significantly more beneficial to the equity, and we're seeing that now. And the activity has picked up because you had a lot of people in the middle of deals, either already owning the land in the middle of pre-development or optioning the land with hard money, and they're in trouble. And we're getting calls on almost a weekly basis now about great deals where the owner developer is saying, listen, I just need capital. I'm willing to be very flexible in terms. So we've never been busier in terms of looking at opportunity right now.
Very good. Very good. Another question is from our group leader, Jack Rybicki, who you know pretty well, Craig. He's asking, given that Arden has both real estate equity and debt funds, do you see one type of those equity versus debt having a higher demand over the next 3 to 5 years? And if so, why?
Yeah. So again, because you guys know all this, the pendulum had been swinging towards credit. As we got further into the economic recovery, people want less risk. So you move out of equity, which is the riskiest part, into debt, lower in the cap stack, and people wanted yield. So we saw that happening right away. And I would say, I don't know, 60, 70 cents of every dollar probably wanted to go into credit. That's at least equalized or changed for two reasons. One, the equity opportunities today are fantastic because values have dropped. And secondly, if you follow the 10-year or LIBOR, which is what we all float off of, it's down so dramatically that yield was low before. Yield is non-existent today. Right. So where you would have lent money, if you were a LIBOR lender, LIBOR was 250 and you went to 250 over, you're getting 5%. LIBOR is at what, 15 or 17 today? The treasury's down in the 50s. So buying debt, the yield that you're going to get, relatively speaking, is the same as it was a year ago, but relatively meaning the spread to the 10-year. But it's way, way down. So I think the combination of pricing coming down, and an enormous amount of capital out there chasing real estate, and that yields are so low in credit, it's at least equal. And it depends on your temperature. If you have any level of risk acceptance, you're probably floating more towards equity and investing in real estate. And if you're completely risk adverse, but you want real estate exposure and yield, you're probably going to go into credit. Just understand what was a 7 is going to look like a 4% return on your money. But there's a place for both. Absolutely.
Good. Got it. Hey, Craig, as we start to round this, to get this wrapped up here, a couple more questions. How about, do you have any worries with respect to industrial real estate? And, tell us, do you believe that manufacturing will be leaving China, coming back domestically? And how does that fare for industrial? And also COVID and what's going on right now. How's that doing?
Yeah, so industrial has been the darling. It was going into this. That and multi were the two top asset classes based on demand growing this way and supply kind of like that, although multi-supply is way up, but not the last mile industrial we do. It's been an enormous beneficiary of this. We're seeing inbound calls at a pace we've never seen before, both to extend, to expand, and new tenancy. And the answer is yes. Manufacturing is coming back for a couple of reasons. One, it's coming back because we're fighting with China, and we'll eventually fix that. We have to, right? I mean, we're 22 trillion, they're 11 or 12. Nobody else is even close, and they're growing faster than everybody. So we have to do business together. They're the largest holder of U.S. debt in the world, so you better be nice to your debt holders. So we'll fix that. It'll get solved. But it's coming back anyway because people realize when these things happen, you're so dependent on manufacturing offshore. If you can't get what you need, you're in serious trouble. So even despite China, manufacturing is absolutely coming back domestically for certain kinds of items. So I think that area will grow. Secondly, e-commerce adoption has been growing, which is what last mile industrial is all about, what we do. You've just force-fed 10 years of e-commerce adoption into 5 months. Everybody, there's so many people who never bought anything on Amazon, even so they know about it. They never did. That's all they've been doing now, whether it's your groceries, your toilet paper, whatever it is. So industrial is going to be the beneficiary of this rapid adoption into e-commerce that was happening anyway at a massive scale. It's just happened faster than that. And then the last thing you have is people now want their own supply distribution channels, or they want a backup. They can no longer rely on somebody else to get their products in and to a customer. And we're seeing that. We're seeing people who are moving away from third-party distributors to their own, and people who are keeping third parties, but they want backup space to be able to handle their own. So across the board, industrial is a big winner. I mean, coming out of this, it's a horrible thing for humanity, but for industrial, I don't know that you could have found something better to drive that business.
Thanks, Craig. And now I want to turn to a question that came from Tony Halata, your friend, our friend Tony. And
Who's
you and
that? Who?
Tony.
I don't know.
And I think you and I spoke about this when we were preparing for the call, and you thought it was an interesting question. So I wonder if you had some time to think about it. But the question was, with every crisis, recession, the market learns something new in the real estate business. What are one or two things that the real estate industry will have learned from this particular crisis? If you look back from, from after a couple of years.
Yeah, I told Tony not to ask that question because it was too but anyway, I think it's a lot of sort of things we thought in the past. I would say expect the unexpected. People always say it, but you forget about it. It happened at 9/11, it happened at GFC, and it happened again. Be prepared for that, which I think further solidifies buying high quality assets in the best markets at fairly low leverage. I think if you're going to buy real estate, that's always a safe bet. Yeah, you're not going to make 30, 40, 50% on your money, but you may not get hurt that bad either. And if you're risk adverse, I think it's a right way to invest. It's different for different asset classes, so we've learned different things. I've learned that, what I thought was a few years ago, high street retail. We thought high street retail was a great investment. We didn't make any because it's not what we do, but I thought, wow, you bake it into these top urban markets. I've learned I don't want to own retail right now. I challenge anybody to tell me the future of retail. And I don't care if it's the highest level, the best stores, the highest luxury brands in the world, the best markets down to the lowest. It's changing at such a rapid pace that industry scares the hell out of me. Someone will find a way to make a boatload of money out of it, though. I'll tell you that. And then I think it goes back to two important things that we sort of knew, but they become crystal clear to us. Don't be over leveraged. Okay, leverage is a great thing, and people were borrowing as much money as they could because it was dirt cheap and so available. It's great in good times, but it will eat you up alive in bad times, and we forget that. We always forget it until something like this happens. Being lower levered is always better. It's worth giving up some of the return, and most importantly are relationships. When bad things happen, you need to have good relationships to get through that. And as Tony knows, we do a daily call. He's almost on every one. We've done almost 100 of them now every day with the company. Those relationships that we've developed and other friends of mine have developed with people have proved to be extraordinarily valuable. When you call them and go, oops, no one's in my hotel. I know I borrowed money from you. I can't afford to pay you. I apologize. Can you work with me? The ability to go, Craig, we've known each other 30 years. Are you kidding me? Of course. What do we need to do to work it out? Versus somebody going, you know what? You were a jerk when you borrowed the money. You've been a jerk every day trying to get money from you. You don't give me new business. The answer is no, pay me. And Tony knows we've seen this over and over. So I would say, generally speaking, be conservative, invest in the best markets, don't be over levered, and you better start building relationships now for the next crisis that we know is coming. We just don't know what it is.
Thank you for taking time out of your busy schedule. I know how crazy it is right now, and all the balls that you have in the air trying to, keep deals going and everything. I also want to thank you personally and from everybody at CLA for being a valuable client of the firm for so many years.
Great. My pleasure. Thanks for having me.
Thank you.